There are moments in markets when the price on the screen tells you almost nothing unless you understand the machinery underneath it. A stock can fall 15% after reporting excellent numbers. A stock can rise after announcing a massive spending plan. A giant technology company can grow revenue at a powerful rate and still disappoint investors. Another giant technology company can increase capital spending by tens of billions of dollars and be rewarded for it. A restaurant stock can look boring and still be one of the cleanest compounding machines in a portfolio. A fintech can get punished in a single trading session while its long-term fundamentals improve. This is why investing is not about reacting to price alone. Price is a signal, but it is not the full system. If you only look at what went up today and what went down today, you will miss the causal chain. You will see SoFi down and think the business got worse. You will see Meta down and think the company is broken. You will see Amazon up and think the market simply loves everything AI. You will see AMD moving higher and think it is random momentum. But if you look through the system, a clearer picture appears. The companies spending the money are not always the best near-term investments. Sometimes the better near-term investments are the companies receiving the money. That is one of the central lessons of this market. The AI cycle is creating a strange split. The largest technology companies are spending enormous amounts of money to build the future. They are buying chips, memory, servers, data center capacity, cloud infrastructure, networking, energy, and AI-related infrastructure. This may create great long-term value for them, but in the short term, it also creates pressure on their expense lines, depreciation, free cash flow, and investor confidence. Meanwhile, the suppliers of that infrastructure can receive enormous demand. NVIDIA, AMD, Micron, those are the kinds of companies that can benefit when Meta, Amazon, Google, and Microsoft all say they are going to spend more. This is not complicated, but it is easy to miss. One company's capex problem is another company's revenue opportunity. That is the first principle. Follow the flow of money. Do not just look at the headline. Ask who is paying, who is receiving, who has pricing power, who can convert the spending into earnings, and who is taking the risk that the spending will not pay off. This is the way I would think about the current earnings season. It is busy because the market is trying to separate companies that are spending with visible returns from companies that are spending with less visible returns. That distinction matters enormously. Let us begin with Meta. Meta reported revenue growth that would be impressive for almost any business of its size. Revenue grew strongly. Among the largest technology companies, it remains one of the fastest growers on the surface. That sounds excellent. But a good income statement is not only about revenue growth. You have to look at the cost structure. Cost of revenue grew faster than revenue. Research and development grew much faster than revenue. Total costs and expenses grew faster than revenue. Income from operations grew, but not with the leverage you would want to see from a company of this scale. That is the problem. In a great operating model, revenue growth should produce operating leverage. If revenue grows strongly, operating income should ideally grow even faster, unless the company is deliberately reinvesting for a future that is clearly measurable. When expenses grow as fast as or faster than revenue, the market begins to ask whether the company is losing control of the spending machine. Meta received a large tax benefit that made net income and earnings per share look much better than the underlying operating story that matters. You cannot simply look at the bottom line growth and conclude everything is fine. You must understand what caused the growth. A tax benefit is not the same as operational leverage. A one-time or unusual benefit can make the numbers look stronger, but serious investors look through it. This is why I would call Meta's income statement good, but not great. It is not weak. It is not a disaster. The company is still enormously profitable. It still owns some of the most powerful consumer platforms in the world. It still has scale that almost no company can match. But the direction of the expenses is a real concern. The market is not angry because Meta is spending. The market is concerned because it is not clear whether Meta needs to spend this much. That is the second principle. Capital spending is judged by visibility of return. If a company spends more and investors can see a direct connection to a rapidly growing business line, the market may accept it. If a company spends more and the payoff is vague, the market becomes nervous. This is the difference between Meta and the other large technology companies right now. Everyone understands that Meta must invest in AI. It is a large technology company. It has social networks, messaging platforms, advertising products, recommendation systems, content feeds, creators, videos, commerce ambitions, and future AI products. It must invest. The problem is the scale. When capital expenditures move into a range that looks extreme, investors want a better explanation. They want to know what business line is absorbing the spending and what measurable growth is coming from it. They want to see the connection between dollars spent and dollars earned. With Meta, that connection is not yet as clear. The company can say it is building for an AI future. That may be true. It can say AI improves recommendations, ads, content ranking, messaging, and future products. That may also be true, but when the spending reaches the level being discussed, the question becomes whether the incremental spending is generating incremental revenue that justifies the pressure on the financial statements. At some point, even a very strong company can spend too aggressively. That does not mean the long-term thesis is broken. It means the near-term math becomes harder. There is also the issue of daily active people. The source document notes that daily active people increased compared with the prior year but declined compared with the most recent quarter and came in below Wall Street expectations. Meta attributed some of this to restrictions and war-related factors that may be fair, but the direction is still something investors do not want to see. For a platform business, engagement is the oxygen. You do not want user activity declining. A temporary explanation can reduce the concern, but it does not erase the signal. If the company is spending aggressively and user activity is not moving cleanly higher, investors become even more sensitive to the spending. This is where the risk comes from. Meta is still a great business. Zuckerberg has come through before. He has made large controversial spending decisions before, and over long periods, he has often been right. But between now and the payoff, the stock can be very volatile. This is a principle that applies to many founder-led companies. A great founder can make decisions that look irrational in the short term and brilliant in the long term, but investors must survive the short term to benefit from the long term. If the founder is spending aggressively and the market loses confidence, the stock can fall a lot before the long-term thesis plays out. This happened before with Meta. When spending became too aggressive and the stock collapsed, the company eventually pulled back, cut costs, and refocused. The stock recovered, but investors who could not tolerate the drawdown did not benefit. So with Meta, the question is not simply whether the company will survive. It will almost certainly survive. The question is whether the current level of spending creates a period of pressure that could drive the stock much lower before the long-term benefits appear. That is why Meta may remain strong as a company but messy as a stock. Those are different things. The third principle is this. A great business can still be a difficult stock if the market loses confidence in capital allocation. Now compare Meta with Amazon. Amazon's income statement tells a different story. Revenue grew strongly. Cost of sales grew more slowly than revenue. Fulfillment grew more slowly. Sales and marketing grew much more slowly. General and administrative costs even declined. Total operating expenses grew more slowly than sales. Operating income grew much faster than revenue. That is what investors want to see. That is operating leverage. Amazon also benefited from a one-time item that made some profit lines look stronger, and taxes were a large expense. A serious investor should notice that, but the underlying operating story is still very good. The most important part is AWS. Amazon Web Services grew faster than Wall Street expected. Its growth accelerated to the high 20s, the fastest pace in more than 3 years, according to the source. This matters more than almost anything else in Amazon's report because AWS is the cloud engine that investors use to judge Amazon's AI infrastructure return. When Amazon spends aggressively, investors can connect the spending to AWS. They can see customers demanding capacity. They can see cloud revenue accelerating. They can see the business line where AI infrastructure spending may convert into revenue and profit. This is why Amazon can spend heavily and still get investor approval. The market can say, I understand the spending because I can see the demand. That is the fourth principle. When CapEx is tied to visible revenue acceleration, investors tolerate it. When CapEx is tied to a vague future, investors discount it. Amazon also has an advertising business that has become a third giant inside the company. The advertising business is growing rapidly and has attractive economics. It benefits from Amazon's e-commerce platform, consumer intent, sponsored product listings, and the fact that sellers need visibility where buyers are already shopping. That is a powerful business. Amazon is not just an online store. It is a cloud company, advertising company, logistics platform, marketplace, subscription ecosystem, and consumer infrastructure company. That is why the long-term thesis remains so strong. The company spends a lot because its opportunities require scale. It has always been a heavy spender. But Amazon has a long history of converting enormous spending into larger businesses. That history matters. When Amazon says it must spend heavily, the market is more willing to trust it because it can point to AWS advertising and e-commerce infrastructure. It can point to specific engines. This is why Amazon remains attractive despite rising technology and infrastructure costs. It has a direct line between spending and growth. That does not mean Amazon is risk. Free technology and infrastructure costs growing faster than revenue in that line item is still a concern. If spending continues to accelerate faster than revenue for too long, margin pressure can appear, but the broad picture is strong. Amazon looks like a company where the spending is heavy, but the return on spending is visible. That is very different from Meta. Now let us move to Google. Google's income statement was even stronger. Revenue grew powerfully for a company of its scale. Total costs and expenses grew more slowly than revenue. Operating income grew faster than revenue. The company had a large other income item that made net income and earnings per share look unusually strong, and that should be separated from the core operating story. But even after thinking carefully about that, the operating performance was very impressive. The key again is the cloud business. Google Cloud grew at a very high rate, significantly ahead of expectations. This is the line item that gives the market permission to accept a very large increase in capital spending. If Google raises CapEx sharply, but Google Cloud is accelerating at a pace that investors can see, then the spending has an identifiable destination. That is the same lesson. Spending alone is not the issue. Visible return on spending is the issue. When Google Cloud grows rapidly, the market says, I understand why you need to spend. You are building capacity for a business that is scaling very fast. This is why Google can increase CapEx and still be rewarded. The market is not blindly approving every AI spending plan. It is approving spending when the company can show the revenue line that supports the decision. Google also has enormous advantages: search, YouTube, Android, cloud, advertising, AI models, data distribution, and deep technical talent. The company has the resources to spend. The question is valuation and timing. The source makes a distinction that is important. Google may be a strong company and still no longer be the most attractive buy after a large move. A stock can be excellent and still not be cheap. If you bought it at a much lower price, you may have a large gain. If you are looking to initiate after a major run, the expected return may be lower. This is the fifth principle. Company quality and stock attractiveness are not the same thing. A wonderful company can be a hold or even a sell if the valuation already reflects too much optimism. A weaker looking company can sometimes be a buy if the market has overpunished it and the long-term trajectory remains strong. This distinction separates investors from fans. Fans love companies. Investors weigh price against future cash flows and risk. With Google, the long-term business remains strong, but after a large move, the risk-reward may not be as compelling as it was when the stock was cheaper. That does not mean the stock must fall. Momentum can continue. Great companies can become more expensive. But as an investor, you must compare opportunity costs. Where's the better future return from here? That is the question. Now, Microsoft reported a strong income statement. Revenue grew well. Some cost lines were controlled effectively. Research and development, sales and marketing, and general and administrative expenses were kept in check relative to revenue growth. Operating income grew faster than revenue. Net income and earnings per share grew faster as well. That is a good report, but the cost of revenue grew faster than revenue, which prevents the report from being perfect. Microsoft is also planning a large amount of capital spending, partly tied to memory prices and AI infrastructure needs. The market must decide whether the spending is justified by Azure growth and AI demand. Azure growth remains strong, but the source notes that it is not accelerating in the same way AWS and Google Cloud appear to be accelerating. That distinction matters. If Azure is growing in the high 30s, that is still very strong. But if the market expected a sharper acceleration, the stock may not receive the same enthusiasm. Microsoft is a phenomenal company, but it is also extremely scrutinized. Investors expect excellence. The company has Office, Azure, Windows, LinkedIn, GitHub AI partnerships, enterprise distribution, and software margins that are among the best in the world. The bar is high. When the bar is high, even strong performance can look merely adequate if the acceleration is not obvious. This is another important principle. Expectations matter as much as results. If expectations are low, good results can create a large rally. If expectations are high, even very good results may not move the stock much. That is why investing cannot be reduced to whether a company is good or bad. The market prices expectations. Now, the more important takeaway from Microsoft, Google, Amazon, and Meta is what their spending means for the semiconductor and memory suppliers. All of these companies are spending aggressively on AI infrastructure. They need chips, they need GPUs, they need memory, they need networking, they need data center hardware, they need the physical layer of AI. That spending flows into companies like NVIDIA, AMD, and Micron. This is why the source argues that over the next 12 to 18 months, the chip-related companies may be more attractive than some of the mega cap companies doing the spending. The logic is straightforward. If Microsoft increases CapEx, that money goes somewhere. If Google increases CapEx, that money goes somewhere. If Amazon increases CapEx, that money goes somewhere. If Meta increases CapEx, that money goes somewhere. A large portion of that money flows toward the AI infrastructure supply chain. That is why AMD can show strength. That is why NVIDIA can remain strong. That is why Micron may benefit from memory demand. The buyers are telling you they are going to keep buying. The suppliers are the ones receiving the cash flow. This is the sixth principle. In an infrastructure build-out, the suppliers can outperform the builders during the heavy spending phase. That does not mean the suppliers are risk-free. NVIDIA, AMD, and Micron can become expensive. Demand can slow. CapEx can eventually normalize. Margins can compress. Competition can increase. A pause in spending from the hyperscalers can hurt them. Semiconductor cycles can be brutal. But while the large technology companies are still aggressively increasing spending, the suppliers have strong near-term support. This is why the source becomes more confident in the chip suppliers over the next 12 to 18 months and less confident in the stock prices of some companies doing the spending during that same period. The builders may create great long-term value, but the suppliers may capture the current wave of spending. This is a common pattern in capital cycles during a boom. The companies selling equipment to the boom often enjoy the clearest revenue acceleration. The companies building the final product may not show profits until later. This happened in many industries. Railroads needed steel and equipment. Cloud needed servers and chips. AI needs GPUs, memory, and infrastructure. The principle repeats. Now eventually the spending will slow when Microsoft, Amazon, Google, and Meta lay off the spending. The story changes. The chip companies may lose some momentum. The mega cap companies may show better free cash flow, lower future depreciation pressure, and improved margins. The market may then rotate back toward the companies that were spending. This is why time horizon matters over the next year or so. Suppliers may have the better setup. Over the longer term, the mega cap platforms may still compound because they own customer relationships, software layers, advertising ecosystems, cloud platforms, and distribution. A good investor must know what time frame they are analyzing. The seventh principle is this: the best stock for the next 12 months may not be the best stock for the next 10 years. Now let us talk about Cheesecake Factory. At first glance, a restaurant company looks very different from AI, cloud, chips, and big tech. It is not building models. It is not spending tens of billions on data centers. It is not buying GPUs. It is selling food. That is exactly why it is interesting in a market obsessed with AI capex. A high-quality restaurant business can provide a different kind of exposure. It does not have to justify an enormous technology spending plan. It does not have to convince investors that data center depreciation will pay off in the future. It has to run restaurants well, control costs, grow concepts, and return cash to shareholders. Cheesecake Factory's income statement was solid. Revenue increased, food and beverage costs improved as a percentage of revenue. Labor expense improved as a percentage of revenue. Other operating costs were less ideal, and that kept the grade from being higher. But the company grew operating income and the bottom line improved significantly, partly because a prior year one-time loss was no longer present. The deeper thesis is long-term expansion. The Cheesecake Factory brand remains a strong sit-down restaurant concept. North Italia and Flower Child provide growth opportunities. Other concepts may follow. The company pays dividends, which creates recurring cash for investors. Those dividends can be reinvested into the same stock or into other opportunities. That is a very different kind of compounding. It is not explosive like AI. It is steady. Steady has value. The eighth principle is this: boring cash flow can be an asset in a market full of expensive dreams. A company like Cheesecake Factory will not usually produce the excitement of a semiconductor leader or an AI platform, but it can provide stability, dividends, brand strength, and expansion potential. If the valuation remains reasonable, it can still be a buy across a range of prices. The source sees it as still attractive because the forward earnings multiple is reasonable. The company has expansion opportunities, and the dividend provides cash flow. The stock may go higher over time if execution continues. The key is that this business does not require investors to underwrite a massive, uncertain AI future. It requires investors to believe people will continue eating at good restaurant concepts and that management can expand intelligently. That is simpler. Sometimes simpler is better. Now, let us move to SoFi. This is the most interesting part of the document because the stock got hit hard even though the income statement looked extremely strong. SoFi's numbers were powerful. Total interest income grew strongly. Interest expense grew more slowly. Net interest income grew substantially. Loan origination sales, securitizations, and servicing revenue grew sharply. Loan platform fees increased. Total non-interest income grew strongly. Total net revenue grew more than 40%. Total non-interest expense grew much more slowly than revenue. Income before taxes surged. Net income grew dramatically. Even though tax expense rose sharply, diluted EPS doubled. That is not a weak income statement. That is a strong income statement, and yet the stock fell heavily. This is why price alone can mislead you. The ninth principle is this: sometimes the market punishes a stock because of expectations, positioning, or fear, not because the business deteriorated. When a high-growth stock runs into earnings, investors may expect perfection. If anything disappoints or if guidance is interpreted cautiously, or if the market was crowded, the stock can fall even on strong numbers. Financial stocks can also carry special risk because investors worry about credit, loans, funding, regulation, leverage, and the possibility of things going wrong inside a balance sheet. SoFi operates in a banking-related space that creates both opportunity and risk. The opportunity is enormous because traditional banking is vulnerable to modern digital competitors. Millions of customers want better apps, lower friction, integrated financial services, investing, lending, crypto access, personal finance tools, and a more modern relationship with money. SoFi is building a broad financial platform that can grow members over time. The risk is that banking, like businesses, can go to zero if balance sheet risk is mismanaged. That is not a small risk. Banks and financial companies can look fine until credit, liquidity, leverage, or asset quality problems appear. So even when a company is trying to keep the business model asset light and generate fee revenue, the risk cannot be ignored. This is why position sizing matters. You can love the long-term opportunity and still refuse to let the stock become too large relative to your portfolio. The 10th principle is this: the bigger the financial system risk, the more disciplined the sizing must be. SoFi's member growth is impressive. Members increased from about 10.9 million to about 14.7 million. That is a large step long term. The source suggests the company could reach 100 million plus members. Whether that happens or not, the direction is clear. The platform is scaling. Member growth is the lifeblood of a consumer fintech platform. More members can mean more products used, more deposits, more loans, more fee opportunities, more cross-selling, more data, and more lifetime value. If SoFi can continue increasing members while improving profitability, the long-term upside can be substantial. The source also highlights Galileo, the technology platform. This had been declining in platform accounts for 2 quarters, but then reversed and grew. That matters because the technology platform had been a concern. If it stabilizes and begins growing again, investors may eventually give SoFi more credit for that business. The market may not have fully respected that reversal in the quarter. This is where opportunity can appear. If the market focuses on short-term selling pressure while the underlying business continues to execute, a long-term investor can benefit, but only if the investor understands the risk. SoFi is not risk-free. It is not the SP 500. It is not a mature bank with a century of history. It is a high-growth financial platform trying to reshape parts of banking and fintech that comes with volatility. The upside is that it could become much larger over time. The source suggests it could become a $50 stock within 5 years and potentially a $100 plus stock long-term. Those are ambitious targets. They depend on continued execution, member growth, revenue growth, profitability, credit discipline, product expansion, and market confidence. The downside is that the banking-related risk never disappears. That is the trade-off. The 11th principle is this: high upside usually exists because the market still sees real risk. If there were no risk, the price would already reflect the opportunity. This is why SoFi can be both an incredible opportunity and a volatile, risky stock. Those things are not contradictions, they are linked. Now, Let us think about the phrase, this stock will be my next Palantir. That comparison is about trajectory. Palantir was a stock that many people doubted, then as execution improved and the narrative strengthened, it became a powerful wealth creator for those who held through volatility. The idea is that SoFi could become a similar long-term compounder if it continues executing and the market eventually recognizes the platform, but comparisons can be dangerous if used lazily. SoFi is not Palantir. The business model is different, the risk profile is different, the balance sheet is different, the customer base is different, the regulatory environment is different. The reason to use the comparison is not to say the stocks are identical. It is to say that the market may be underestimating a company with a large addressable market, improving execution, and long-term expansion potential. That is the useful part of the comparison. The 12th principle is this: analogies help you think, but they should not replace analysis. Now let us reflect on the earnings season pattern across all these companies. Meta has strong revenue but questionable spending discipline and unclear return visibility. Amazon has strong revenue, visible AWS acceleration, and advertising strength, making its spending easier to justify. Google has powerful operating leverage and explosive cloud growth, also making higher capex more acceptable. Microsoft has strong profitability and disciplined operating lines, but Azure acceleration is less dramatic than AWS, and Google Cloud chip suppliers benefit from the spending by all of them. Cheesecake Factory offers steady, non-I-dependent growth and dividends. SoFi shows exceptional growth and profitability progress, but the stock is punished because of risk expectations and financial sector concerns. This is not random. It is the market sorting through capital allocation visibility and future return. The 13th principle is this: the market rewards growth when it trusts the pathway from spending to profit. When the pathway is unclear, the market discounts the stock. This is why earnings calls, segment growth, capex guidance, and expense lines matter. You cannot just look at EPS. You must understand the quality of earnings. Was EPS helped by a one-time tax benefit? Was net income helped by one-off other income? Was operating income growing faster than revenue? Were costs controlled? Was the cloud segment accelerating? Was capex tied to visible demand? Were member counts growing? Was a troubled platform segment stabilizing? These questions reveal more than the headline number. Now let us think like a capital allocator. If you had to allocate capital today, where is the best risk? Reward. Meta may be a long-term winner, but near-term spending risk is high. Amazon may remain a buy because its growth engines are visible and its valuation is not extreme relative to its future. Google may be a great company but less attractive after a large run. Perhaps more of a hold. Microsoft remains high quality, but the setup may depend on whether Azure can reaccelerate and whether capex pressure is manageable. Nvidia, AMD, and Micron may have the strongest near-term demand tailwind because the hyperscalers are still raising spending. Cheesecake Factory may offer stable compounding and dividends. SoFi may offer high long-term upside after a sell-off, but with financial sector risk. This is not a one-size-fits-all list. It depends on your time horizon, risk tolerance, concentration, valuation, and existing exposure. A conservative investor may prefer Amazon or Cheesecake. A more aggressive investor may look at SoFi. An AI infrastructure-focused investor may prefer Nvidia, AMD, or Micron. A long-term believer in Zuckerberg may hold Meta through turbulence but must accept volatility. A valuation-sensitive investor may avoid chasing Google after a huge move. The answer depends on the portfolio. The 14th principle is this: there is no best stock in isolation. There is only best fit for a specific portfolio and time horizon. Now let us talk more about Meta spending because it is the clearest negative example. Capital expenditures at Meta moving towards such a large range creates future expense consequences. The spending today does not only affect cash today, it creates depreciation in future periods. It requires ongoing maintenance. It can pressure free cash flow. It can raise the burden on future revenue to justify the investment. If the company is right and AI creates massive future returns, the spending may look brilliant. If the company is early, excessive, or unclear in monetization, the stock may suffer for years before the payoff becomes visible. This is the same tension every major technology platform faces. Spend too little and you fall behind. Spend too much and you destroy near-term financial quality. The optimal point is hard to find. Zuckerberg may believe the risk of underinvesting is greater than the risk of overspending. He may be right, but investors must decide whether they are willing to accept the volatility that comes with that belief. This is the 15th principle. Strategic necessity does not eliminate financial discipline. A company can need to invest and still invest too aggressively. Now, Amazon's spending is different because AWS gives investors a measuring stick. If AWS revenue growth accelerates to the 30s, the market can say the spending is working. If advertising continues growing in the 20s, the market can see another profit engine if e-commerce remains stable. The company has multiple pillars that makes the story more diversified. Google's spending is also accepted because Google Cloud is now big and growing rapidly. A $20 billion quarterly cloud business growing over 60% gives the market a clear signal. The spending is not abstract, it is tied to demand. Microsoft's spending is accepted but watch because Azure is still strong but not showing the same acceleration. The market may still trust Microsoft because of its enterprise dominance and profitability, but it may demand evidence. This is how the market differentiates. Same AI theme, different investor reaction. The 16th principle is this: the same macro trend can create very different stock outcomes depending on company-specific execution. AI is not enough as an investment thesis. Everyone says AI, but who monetizes it, who supplies it, who controls customer relationships, who has pricing power, who has margins, who has reasonable valuation, who can spend without weakening the financial statements too much? That is the analysis. Now, the chip suppliers, Nvidia remains the dominant AI chip story. AMD is showing strength and may benefit from customers wanting alternatives and additional supply. Micron can benefit from memory demand, including high bandwidth memory and broader infrastructure needs. If the big technology companies keep raising capex, these suppliers may continue to receive demand. This is why the source says owners of those stocks can sleep well in the near term. But as a systems thinker, I would add a caution. Sleep well does not mean ignore valuation. It means the demand signal is strong. If valuations become too stretched, future returns can still disappoint. If capex eventually slows, the cycle can turn. Semiconductor businesses can have strong up cycles and sharp down cycles, so the trade may be strong, but it is not permanent. The 17th principle is this: cyclical strength should be owned with an awareness of the cycle. You can ride the wave, but do not pretend the wave is the ocean. Now let us think about SoFi as a long-term compounder. The business is trying to become a central financial platform for consumers. Banking, lending, investing, crypto, financial services, technology platform, and member growth are all part of the story. If the company continues expanding products per member, increasing deposits, improving profitability, and growing its brand, the long-term value can be much higher. The market may underestimate the power of a financial super app in the US if execution is strong. Traditional banks have large customer bases, but often weaker technology and less inspiring customer experiences. Fintech companies have innovation, but not always full banking capabilities. SoFi is trying to combine both. That is the opportunity. But the risk is that financial services are hard, regulation is heavy, credit cycles can damage lenders, customer acquisition can be expensive, competition is fierce. Big banks are not passive, fintech peers are aggressive. If the economy weakens, loan quality can matter more than revenue growth. That is why the stock can be punished even after strong numbers. The market asks, how durable is the growth across a full credit cycle? That is the key question. The 18th principle is this. For a fintech, growth is good, but credit discipline determines survival. If SoFi can grow without taking excessive balance sheet risk, the upside can be significant. If it grows by taking hidden risk, the stock can become dangerous. The source believes management has executed impressively and that Anthony Noto has built a real force in banking. That may be true, but investors should keep watching the quality of execution, member growth, net interest income, non-interest income, loan sales and securitization, technology platform accounts, profitability, credit quality, capital levels, operating leverage. These are the dashboard items. If they continue improving, the long-term thesis strengthens. If they weaken, the thesis must be re-examined. Now let us discuss why a stock like SoFi can fall after an A+ income statement. Markets are not grading papers in a classroom. They are pricing future uncertainty. If investors had already priced in strong numbers, the stock can fall even after strong results. If investors worry that growth will slow, or that credit risk will rise, or that expectations have become too high, the stock can sell off. Sometimes investors take profits, sometimes the market rotates away from risk. Sometimes algorithmic trading reacts to one line item or guidance comment. This is why earnings day reactions can be noisy. A long-term investor should not ignore the reaction, but should not be ruled by it. Ask what changed in the long-term thesis. If the thesis improved and the stock fell, that may be opportunity. If the thesis weakened and the stock fell, that may be a warning. Price plus fundamentals equals information. Price alone is not enough. Now let us think about income statement grading as a method. The source grades income statements based on whether revenue growth is strong, whether costs grow slower than revenue, whether operating income grows faster than revenue, whether net income quality is strong, whether one-time items distort the bottom line, and whether segment growth supports the strategic thesis. That is a useful method. A company with 33% revenue growth can be a B if expenses grow too quickly and capex visibility is poor. A company with 17% revenue growth can be an A if operating income grows 30% and key segments accelerate. A company with 22% revenue growth can be an A+ if costs are controlled and cloud growth explodes. A company with 43% revenue growth and net income up over 100% can be an A. Plus, even if the stock falls, the grade is about business performance. The stock reaction is about expectations and future risk. Those must be separated. The 19th principle is this. Separate the income statement from the stock chart. They interact, but they are not the same thing. Now, what should investors do with this information? First, understand that AI spending is not uniformly bullish for every tech stock. It is bullish for suppliers while spending continues. It may be mixed for platforms if spending pressures margins without visible returns. Second, watch cloud growth. AWS, Google Cloud, and Azure are critical signals. Acceleration justifies spending. Deceleration makes spending more questionable. Third, watch capex guidance. When companies keep raising capex, ask who benefits and who pays. Fourth, watch operating leverage. Revenue growth is not enough. Operating income should ideally grow faster unless there's a clear reinvestment case. Fifth, watch one-time items. Tax benefits and other income can distort net income and EPS. Sixth, look for punished stocks with improving fundamentals. SoFi may fit that category if the thesis remains strong. Seventh, do not overconcentrate in financial stocks or high-risk growth names. Upside and risk come together. Eighth, respect steady businesses. Cheesecake Factory may not be exciting, but stable cash flow and dividends can be valuable. This is a better framework than chasing headlines. Now let us talk about portfolio construction. A portfolio can include different types of assets. Compounders like Amazon, high quality but valuation sensitive giants like Google and Microsoft, founder-led long-term bets like Meta, with spending risk AI infrastructure suppliers like Nvidia, AMD, and Micron, stable cash flow businesses like Cheesecake Factory, high upside growth financial platforms like SoFi. Each position has a different job. The mistake is treating every stock like it should behave the same way. Meta will be volatile because capex uncertainty is high. Amazon may be rewarded for visible cloud acceleration. Google may be strong but less cheap after a huge run. Microsoft may be steady but scrutinized. Chip suppliers may benefit from the current spending wave. Cheesecake may provide steadier compounding. SoFi may offer asymmetric long-term upside with real risk. A portfolio should balance these roles. The 20th principle is this. Know the job of every stock you own. If you own Meta, you own a long-term platform with near-term spending risk. If you own Amazon, you own a multi-engine compounder with cloud and advertising strength. If you own Google, you own a highly profitable AI and cloud giant. But valuation matters after a large move. If you own Microsoft, you own an enterprise software and cloud leader with AI infrastructure spending and Azure expectations. If you own Nvidia, AMD, or Micron, you own the suppliers to the AI capex wave. If you own Cheesecake, you own restaurant expansion and dividends. If you own SoFi, you own a high growth financial platform with banking related risk. This clarity prevents emotional decisions. Now, let us think about valuation. Valuation is not always simple. A high-growth company can deserve a high multiple. A low-growth company may deserve a low multiple. A cyclical company can look cheap at peak earnings and expensive at trough earnings. A financial company can look cheap before credit risk appears. A technology company can look expensive before a huge growth wave. So valuation must be tied to future earnings quality. The source mentions Amazon's forward P/E not being unreasonable, especially if earnings per share estimates rise after strong beats. Cheesecake's forward P/E is also seen as reasonable given growth and dividends. Google may be less attractive because the stock already moves significantly. SoFi's valuation after a sell-off may be attractive if long-term growth continues. The principle is not buy low P/E and sell high P/E. The principle is buy future cash flows at a price that gives you enough return for the risk. That requires judgment. Now let us discuss the danger of short-term focus during earnings season. Earnings reactions can be violent. SoFi down 15%, Robinhood down, Coinbase down, HIMS down, MicroStrategy down. Meanwhile, AMD up, Amazon up, Google up, Meta down. These moves can make investors feel they must react immediately. But long-term wealth is rarely built by reacting to every after-horse move. The better approach is to interpret the data. Did the business improve? Did the thesis improve? Did the valuation become more attractive? Did risk increase? Did expectations change? Is this a one-quarter issue or a multi-year issue? For Meta, the spending problem may last for years. For Amazon, AWS acceleration may improve the multi-year thesis for Google. The business is strong, but valuation may be less compelling. For Microsoft, the company remains strong, but cloud acceleration must be watched. For chip suppliers, the spending wave strengthens the near-term thesis for Cake. The steady compounding thesis remains intact. For SoFi, the long-term opportunity may have improved despite the price decline. That is the analysis. Now, let us think about SoFi's risk more deeply. The source says the risk is zero, meaning bankruptcy or severe impairment. That sounds blunt, but in financial companies, it is the risk investors must acknowledge. Banking related businesses have balance sheets. If they take bad risk, things can unravel quickly. Even if management is trying to stay asset light, lending and financial intermediation always require caution. This is why you never let a stock like this become too much of your net worth. You can have conviction, but you must also have humility. If SoFi becomes a $50 stock within 5 years or a $100 stock long term, it can create significant returns. But if something goes wrong, the downside can be large. So the correct approach is not blind enthusiasm. It is measured conviction. Own enough to matter. Do not own so much that being wrong destroys the plan. That is the 21st principle. High conviction should increase research, not eliminate risk controls. Now let us talk about Anthony Noto and management execution. Management matters enormously in a growth financial platform. The company has to balance growth, credit risk, profitability, product expansion, regulation, technology, and customer trust. If management executes well, the platform can scale. If management chases growth at the wrong cost, the risk rises. The source is impressed with execution so far. The member growth, revenue growth, profitability growth, and Galileo reversal support that view. But execution must be monitored. Great quarters do not guarantee great decades. The thesis must be continuously tested. This is another principle. Never outsource your conviction permanently to management. Trust, but verify through numbers. Now let us return to the macro backdrop. The market is in a phase where AI capex is enormous. Earnings are strong, and the biggest companies are being separated by their ability to justify spending. This is not a normal earnings season because AI investment has become one of the central drivers of capital allocation. The companies that spend well may dominate the next decade. The companies that overspend may suffer. The companies that sell into the spending may enjoy a powerful cycle. The companies outside AI but with stable growth may offer valuable diversification. The companies punished despite improving fundamentals may offer long-term opportunity. This is a rich environment for investors, but only if they think clearly. The 22nd principle is this. In a capital spending boom, do not only ask who has the boldest vision, ask who captures the cash flow now. The source repeatedly says not to get too focused on the short term and to focus on companies with amazing long-term trajectories. That is correct, but it must be combined with valuation and risk. A long-term trajectory can be strong and still be overpriced. A stock can have a short-term dip and still be dangerous. The long-term is not a magic phrase that fixes bad entry, bad sizing, or bad analysis. The right long-term mindset is disciplined. It does not panic over one quarter. It also does not ignore important signals. For Meta, the capex signal is important. For SoFi, the fundamental signal is important. For Amazon and Google, the cloud acceleration signal is important. For Microsoft, the Azure acceleration signal is important. For chips, the hyperscaler spending signal is important. For Cake, the cost control and expansion signal is important. A long-term investor watches the signals without overreacting to the noise. Now, let us think about what can go wrong in each thesis. Meta could continue raising capex, pressure margins, and lose investor confidence. Daily active people could stagnate or decline. AI spending may not produce enough incremental revenue soon enough. Amazon could face rising infrastructure costs, AWS competition, consumer weakness or margin pressure, advertising growth could slow. Google could face AI search disruption, regulatory pressure, rising capex, or valuation risk. After a strong move, Microsoft could face Azure growth deceleration, margin pressure from AI infrastructure, or valuation compression. NVIDIA, AMD, and Micron could face a capex slowdown, supply, demand imbalance, competition, or cyclical reversal. Cheesecake could face restaurant traffic weakness, labor costs, food inflation, or consumer pressure. SoFi could face credit risk, regulatory pressure, funding pressure, customer acquisition cost issues, or execution risk. Every thesis has risks. The investor's job is not to deny them. The investor's job is to decide whether the upside justifies them. Now, what can go right? Meta could convert AI spending into stronger ad targeting, engagement, and new products. Expense discipline could return after market pressure. Amazon could see AWS growth accelerate into the 30s. Advertising continue compounding, and operating leverage improve. Google could monetize AI across search, cloud, YouTube, and enterprise tools, while cloud continues scaling. Microsoft could continue turning enterprise AI demand into Azure Office. And software revenue, NVIDIA, AMD, and Micron could receive sustained demand from hyperscaler capex and AI infrastructure build-out. Cheesecake could expand North Italia, Flower Child, and other concepts while paying dividends and growing earnings. SoFi could scale toward tens of millions more members, expand product adoption, improve profitability, and become a serious threat to traditional banks. These are the upside cases. A portfolio is built by weighing upside against risk and price. Now, let us bring this into a simple decision framework for each company. Ask 5 questions. Is revenue growth strong? Are costs growing slower than revenue? Is operating income growing faster than revenue? Is capital spending tied to visible future revenue? Is the stock price already reflecting the good news? If you apply that framework, the source S conclusions become clearer. Meta passes revenue growth, but struggles on expense growth and capex visibility. Amazon passes revenue, operating leverage, and visible AWS acceleration. Google passes revenue, operating leverage, and visible cloud acceleration, but valuation is less attractive after a large move. Microsoft passes most financial quality tests, but Azure acceleration is less dramatic and capex still matters. The chip companies benefit because they receive the capex. Cake passes stable growth and valuation discipline. SoFi passes growth and operating leverage, but carries financial sector risk. This framework is useful beyond this one earnings season. Now let us think about the human tendency to overreact. When SoFi falls 15%, people want to know what is wrong. Sometimes the answer is not that something is wrong. Sometimes the answer is that the stock moved too fast. Expectations were high, or investors took profits. When Meta falls, people want to know whether it is dead. It is not dead, but the spending problem is real. When Google rises, people want to chase maybe the company is excellent, but the entry may be less attractive. When AMD rises, people want to know if they missed it. Maybe not. If hyperscaler capex keeps increasing, this is why emotions are unreliable. The market moves faster than the mind can interpret. Principles slow the mind down. That is their value. Now let us talk about dividends in the context of Cake. Dividends are often underappreciated in high growth markets because they feel boring, but a dividend paying stock can create optionality. Every quarter cash comes in. That cash can be reinvested into the company if attractive, or moved into other opportunities if another stock becomes cheap. This creates a self-funding mechanism in a volatile market. Cash flow has value. A company that pays dividends and still has growth potential can be a strong long-term holding. This is not to say dividends are always good. A company should not pay dividends if it has better reinvestment opportunities or if the dividend weakens the balance sheet. But for a mature, stable restaurant business with expansion opportunities, dividends can be part of shareholder return. Again, every asset has a job. Cake's job is not to be NVIDIA. Its job is steady compounding cash flow and expansion. Now, let us think about why big tech capex can create future pain. When a company spends heavily on data centers and infrastructure, the cost does not disappear after the cash is spent. Assets depreciate, future expenses rise, maintenance is needed. If demand does not grow fast enough, returns on invested capital can fall. Free cash flow can be pressured. This is why capex is not always good. Capex is good when it creates future cash flows above the cost of capital. Capex is bad when it becomes empire building, defensive overspending, or unclear investment. The market is trying to decide which is which. Amazon and Google are being given the benefit of the doubt because cloud growth is visible. Meta is not being given the same benefit because the AI return line is less visible. Microsoft is somewhere in between. That is the essence of the current big tech split. Now, the source us conclusion that chip suppliers are the near term play comes from this capex analysis. If every hyperscaler is raising the spend, the chip suppliers may remain supported. But the eventual risk is that the spending wave normalizes. At that point, the market may shift focus from supplier revenues to platform returns. A good investor must anticipate rotation. The 23rd principle is this: leadership changes when the market moves from build out to monetization. During build out, suppliers win. During monetization, platforms may win. During overbuilding, everyone can suffer. The question is where we are in the cycle. Right now, the source argues we are still in the spending wave. Now let us think about SoFi's long-term target more conservatively. A $50 stock in 5 years would require the market to believe SoFi's growth and profitability can scale significantly. A $100 plus stock long-term would require even more. These outcomes are possible only if execution remains strong and risk stays controlled. The stock at $15 may look attractive relative to that upside, but the downside is real if the company disappoints or the market loses confidence in financial technology risk. So a good investor may buy, but not blindly. They may build slowly. They may watch credit quality. They may monitor member growth. They may compare revenue growth to expense growth. They may study whether Galileo's reversal continues. They may evaluate whether loan sales and fee income remain strong. They may treat volatility as normal. That is how to own a high-growth financial stock responsibly. Now let us bring SoFi back one more time because it is the headline growth stock in the source. Why is it attractive? Revenue growth is powerful. Net interest income is growing. Non-interest income is growing. Loan-related revenue is strong. Loan platform fees are strong. Profitability is improving. Members are growing toward 15 million. Galileo showed signs of reversal. Management execution has been strong. The stock fell sharply, creating a potentially better entry. Why is it risky? It is in a banking. Related space, credit and balance sheet risks exist. The market may remain volatile. High expectations can reset. Competition is intense. Regulation matters. Execution must continue. This is the full picture. If you only see the upside, you are being promotional. If you only see the risk, you may miss opportunity. A good investor sees both. Now, let us consider why traditional banks should care. If SoFi continues growing members and products, it can become a threat to incumbents like Wells Fargo, Bank of America, and JP Morgan. Big banks have enormous scale, but they are also slow, bureaucratic, and often less loved by younger customers. A modern financial platform with strong digital experience can take share over time. But traditional banks have deep relationships, regulatory experience, capital trust, and diversified businesses. They will not simply surrender. SoFi must earn its growth. The fact that the opportunity exists does not mean the path is easy. Again, upside and risk. Now, let us think about the role of stock price targets. Saying a stock can reach $50 or $100 helps create a mental picture of upside. But the more useful question is what must happen for that target to be justified? How many members? What revenue per member? What net income margin? What multiple? What credit quality? What capital needs? If those assumptions make sense, the target becomes more grounded. If they do not, the target is only a dream. The source is enthusiastic. The disciplined investor converts enthusiasm into assumptions. That is the 24th principle. Turn price targets into operating assumptions. Now, the same applies to Amazon. If Amazon is always a buy, why? Because AWS advertising, e-commerce, logistics subscriptions, and long-term growth can continue compounding. But at some valuation, even Amazon can be less attractive. The statement always a buy should really mean that over long time horizons and reasonable valuations, Amazon has repeatedly rewarded investors. Still, price matters. No company is infinitely attractive at every price. Now, Google after a large move may be less attractive as a new buy even if it remains a great hold. This is an important discipline. Investors often want to buy what is working right now. But sometimes the best buy was before the great quarter, when the market doubted the company. After the market recognizes the strength, the future return may be lower. This is why buying fear can be more profitable than buying comfort. SoFi after a sell-off may be more interesting than Google after a huge run, even though Google is the higher quality business that is uncomfortable but logical. The 25th principle is this: the best opportunity often appears where quality is improving but sentiment is weak. Now, let us think about Meta in that context. If Meta falls enough because capex fear becomes extreme, it may eventually become a great opportunity again. But the timing depends on whether spending discipline returns or investors can see the return. If the stock falls before the operating issue improves, buying too early can be painful. So a watchful investor may wait for either a lower price, clearer spending discipline, or stronger evidence of AI monetization. This is not abandoning Meta. It is respecting the risk. Now let us discuss the difference between public portfolio moves and private conviction. The source speaks from a public account and mentions positions that creates transparency, but also can influence viewers emotionally. A viewer may feel pressure to copy. That is dangerous. Your financial life is not someone else's portfolio. Their net worth, cash reserves, time horizon, risk tolerance, tax situation, and emotional capacity may be completely different. Learn from the framework. Do not blindly copy the position. That is the 26th principle. Borrow the process, not the portfolio. Now, let us bring everything to the ending. This earnings season is showing a clear split. AI spending is not slowing. Cloud demand is real. Some companies are proving that spending is translating into growth. Some companies are not yet proving it clearly enough. Chip suppliers are receiving the money. Steady non-A businesses still have value high. Growth fintech can be punished even when the business improves. The market is not perfectly rational in the short term, but it is asking rational questions. Where is the operating leverage? Where is the return on capex? Where is the visible growth line? Where is the risk hidden? Where is the stock price already reflecting optimism? Where is the market overreacting? These are the questions that matter. Now I will put it into principles. First, follow the money when the largest technology companies raise AI capex. The money flows to chips, memory, infrastructure, and suppliers. Second, judge capex by visible returns. Amazon and Google have cloud acceleration. Meta has less visible return on spend. Third, separate business quality from stock attractiveness. Google is excellent, but the better entry may have been earlier. SoFi is risky, but the sell-off may create opportunity. Fourth, watch operating leverage. Revenue growth is not enough if expenses grow faster. Fifth, treat one-time benefits carefully. Tax benefits and other income can make EPS look better than the core business. Sixth, respect stable compounders. Cheesecake Factory is not AI, but it can still be a strong long-term business. Seventh, size risk. SoFi may have huge upside, But banking-related risk demands discipline. 8th, think in time horizons. Chip suppliers may be better for the next 12 to 18 months, while hyperscalers may remain powerful over longer periods. 9th, do not react to price alone. A stock falling after earnings does not always mean the business got worse. 10th, keep the portfolio aligned with your own life. No stock is worth destroying your financial system. This is the lesson: markets move fast during earnings season. They reward, punish, confuse, and exaggerate. But under the volatility, the system is visible if you know how to read it. Meta is spending aggressively without enough visible return yet. Amazon is spending aggressively with AWS and ads showing strength. Google is spending aggressively with cloud growth exploding. Microsoft is strong but needs Azure acceleration to justify the size of the spending. Nvidia, AMD, and Micron are receiving the capex wave. Cheesecake Factory is quietly compounding outside the AI noise. SoFi is growing rapidly and may be one of the most interesting long-term opportunities after being punished. That is the map. The investor's job is not to chase every move. The investor's job is to allocate capital where the risk, reward, time horizon, and evidence line up. If SoFi becomes the next great long-term growth story, it will be because it keeps executing, keeps growing members, keeps improving profitability, and manages financial risk. If AMD, Nvidia, and Micron keep winning, it will be because AI capex continues flowing into the infrastructure layer. If Amazon and Google keep compounding, it will be because cloud and advertising convert spending into earnings. If Meta recovers from this pressure, it will be because Zuckerberg eventually proves the spending was worth it and reins it in when needed. None of this is guaranteed, but the pattern is clear. The money is moving. The capex wave is real. The market is separating companies that can show the return from companies that cannot yet show it. And the best opportunities may not always be in the stock that looks the safest today. Sometimes the best opportunity is the stock the market just punished. If the business is getting stronger, sometimes the best opportunity is the supplier that gets paid while others build the future. Sometimes the best opportunity is the boring company that keeps compounding while everyone argues about AI. The key is to see the system and act with discipline. That is what good investing requires.